The S&P 500.
S&P 500.
For the S&P 500.
The S&P 500.
Hold on, before we go any further, let me just set the record straight. This is in no way, shape or form formal advice. This is not any sort of formal financial advice. I am not an accountant. I do not come from that background. I got a law degree. And this is really just about how someone who does not have a formal financial background, doesn't have a finance or accounting degree, didn't work in banking or finance, but still managed to leverage the information that I had all around me from online and from books, because it definitely wasn't anywhere else, to really start building an investment portfolio. It's probably also sensible of me to say that if I were you and I was watching this video, I personally would work on becoming debt-free, building up my emergency fund and making sure that is nice and secure and to the number that I've set out. Potentially have a regular income that's coming in, but even if not, none of these things are prerequisites to invest in. You can invest with £100 if all you have is £100, and if you are that inclined and that way inclined when it comes to risk. But if you want to minimize some of that risk to begin with, before you even put money into any sort of investment vehicle, probably have a look at whether you've got some debts that needs to be paid off first. There's an emergency fund number that you're working towards, and then also maybe trying to get some regular income in as well. Let's get into this video on the things I wish I knew about the S&P 500 before investing in it. What is the S&P 500 and why is everyone always talking about it? So the S&P 500 is essentially an index, so think of it like a scoreboard, and it tracks 500 of the best performing US companies. You have a range of different industries and sectors that make up the S&P 500 that we're gonna get to in a second. But just a few key things to know. One, it's an index. Secondly, you can't directly buy it, because what the S&P 500 does is track performance, kind of like a scoreboard. It's an index. But what you can do is invest into a fund that tracks the S&P 500. So in a way mirrors what's happening on this S&P 500 index / scoreboard that we've got going on. And these funds are called exchange traded funds, so ETFs for short, which you'll probably hear and see around a lot. And these ETFs basically act like a basket, and they hold shares, or let's say eggs, of all of the top 500 US companies. So in this way, you don't have to invest in just one of the eggs in that basket. You can quite literally invest in all of them. So for example, Vanguard have an ETF that you can invest in, the S&P 500 one. VUSA, VAG, I don't know if that's how you pronounce it, VAG. One is accumulating and one is distributing, and we'll get into the specifics of that later, or even potentially in another video. So these ETFs essentially track what's going on in the S&P 500 index. So if there's a particular company that leaves the S&P 500 because they're not part of the top 500 performing US companies anymore, then that will be reflected as well in your ETF, because the ETF mirrors what is happening in this index. I love it because it helps investors like me who are not full-time traders and have other things that they're doing in life, so don't have the time to be checking on the performance of individual companies and buying and selling stocks and timing everything. I just want to be able to invest in the top 500 companies, and if they stop performing, then you can remove them, and if there are better ones performing, you can add them in. It means we don't have to actively manage our portfolios. And overall, we'll speak a bit more about the benefits, but it exposes you a lot less to the volatility of investing in just one company. The ETFs do this all for you. It's also quite helpful for diversification, because it ensures that the money that you put into a particular investment isn't relying solely and isn't too exposed to just one sector. The S&P 500 has the top 500 US businesses, and this is across a range of different sectors, from healthcare to tech to finance. Because if you were to invest all of your money into just one sector and that sector collapses, that means all of your money is gone. It really does reduce risk, because if there is poor performance, let's say in the healthcare sector, that is essentially balanced out by the really great performance of tech or finance. So it's a good way to diversify and ensure that you are not putting all of your eggs in one sector's basket. It's a low cost, less headache, and quite popular way of investing into the US economy. Now let's go into the things that shocked me, again, as someone that doesn't have a finance or accounting or sort of degree, that didn't go into working in finance or in banking, but still managed to do okay with her investment portfolio. Number one, the S&P 500 is not a get rich quick scheme. And this is something that I definitely learned the hard way. I think I've spoken about this a little bit before, but the point here is that it's a long-term play. The S&P 500 is typically spoken about in a way that it's reliable and it's safe, and there is a reason for that. Let's also not forget that its popularity and its reputation comes from its long-term historical success. We're talking 10, 20, 30 years. We're talking decades in the game. So when we are looking at a graph, we're not just looking at last year, 2025 to now. We're typically looking over the past few decades, and this is where it gets its reputation for being reliable and for being safe. There are loads of different S&P 500 calculators for this sort of thing as well, and I'll try to put one here or somewhere basically. But what they essentially do is, if you put in the amount you want to invest over a certain period of time and the years you want to do that for, it will basically spit out a number based on the S&P 500's historical performance, and tell you that if you invest £100 every single month for 10, 15, 20 years, this is how much your investment will grow to. And it's important to see that these calculators normally have a starting point of 5 or 10 years. This is not a get rich quick scheme. Depending on what your goal is, this could literally be decades. I started investing in the S&P 500 when I was 23 years old. I'm now 27. It's been 4 years or so. Yeah, 4 years. And I first went in at 23 saying, I'm going to invest for 10 years. And now that it's been nearly halfway at that point, and I look at my investment, which is looking very healthy, by the way, I've now changed my stance. I want this to be even longer than that initial 10-year period I put. I'm very happy for it to go to 15, 20 years from when I first put my first £100 when I was 23 years old. And 20 years for me would be when I'm 43 years old. I'll probably still look really hot. So, long-term play. It's not a get-rich-quick scheme if that's what you're looking for. Unfortunately, I don't know how the algorithm got you here, but you are watching the wrong video. Don't over-obsess. When I first put my, I think it was first £100 in the S&P 500, I wanted to check my portfolio every single day, every week, literally every other week, and just see how much money I've made. Am I a millionaire yet? And if not, what is happening? So the first thing I want to say about the S&P 500, don't over obsess, don't over fixate on numbers. This is a long-term play. So you are making a long-term decision. Checking your portfolio every week, every day, every minute, every hour, or even every time there's a market dip. Honestly, if you are a beginner and you're just starting your journey now, you are not going to see anything significant very soon. Don't let that discourage you as well. Just remember, this is a long-term play. It's a long-term strategy. It's a long-term decision. I think another key thing here about don't over-fixate and don't over-obsess with the numbers is also when there's a market dip. Do not let your emotions control you. Go by logic more than you'll go by emotions. Because if you see that the market has dipped, your instinct is going to be, I need to get out of it. Let me sell everything. And you'll probably find that you're going to sell at a loss as opposed to a profit, which you could do if you just wait for the market to calm down and sell much later in the future. A lot of the time, this leads to panic selling. So, I mean, the main point here is just don't over-fixate on the numbers. Unless, for example, you are taking advantage of a market dip and you intend to invest a lot right now, like significant sums of money, so that you can essentially take advantage of lower prices. But other than that, if you are someone that's just looking to get in and invest £1, £2, £3, £4, £500 a month, don't fixate on the numbers too much. Just let the market do its thing. Over obsessing about the numbers and looking at your portfolio a bit too much can also make you start to think, I should probably remove this money and use it on, I don't know, a new bag or something. So just leave the money where it is and just let the market do its thing. A key way in which I can do this is by automating everything. And this is point 2. Automate and forget. This is what I do, and this is what I live by. Automate your accounts in a way that each time you get paid at the end of the month, there is dedicated money that goes straight into your Vanguard account or whichever account you're using. But this is really helpful and really important because sometimes when you get a nice check at the end of the month, for a lot of people, the first thing to think about isn't about investing in the S&P 500 or investing in anything really. So a way to kind of remove that mental friction is just automating your accounts. You won't have to forget about it. You won't have to do this mental wrestle about taking your money from your account and putting it into your Vanguard or whatever account it is that you're using. You can just automate it and forget. Your account knows on the 31st of every single month, there is a direct debit that it must action and it goes into your Vanguard. Firstly, automate it, but then secondly, forget about it. When I go on my bank statement after I'm paid and I see the hundreds that have gone into my Vanguard, I'm like, oh, okay. Because I know it would take quite a lot for me, especially in the early days, to intentionally put that into whichever investments are part of my portfolio. So yeah, forget about it. Don't think about it. See it in your account and just turn a blind eye and keep scrolling. I guess automating and forgetting was a much easier step before Vanguard released their mobile app in the UK about, I think, I'm going to say like a year and a half ago. But before that, if you were in the UK, you were actually unable to get the Vanguard app on your phone, which made things a lot easier. I know stories of people that have just forgotten their password and they don't even want to log in. Kind of reckless, but you know, whatever works for you. But yes, even though you have the Vanguard app on your phone, just try to not look at it too much. Try and automate and forget. Something else I learned in this journey is that the S&P 500 isn't the only thing that I should or could be investing in. And yes, everyone talks about it and it's highly praised, but it doesn't mean it's the only option. And it took me some time to learn this because honestly, my portfolio was just equities and part of that was just the S&P 500. That was all. So as we said, the S&P 500 tracks 500 of the largest US companies, right? But then doesn't that also mean that you are extremely heavily exposed to the US market? And it's not necessarily a bad thing. I'm not saying it's a bad thing, but it's something to be aware of because let's say in a universe that the American economy completely crashed, that would mean the same fate for your portfolio. And as I went through this journey, I started to think about what could I invest in outside of the S&P 500, but even to zoom out a little bit more, and what can I invest in that is outside of equities? So outside of this asset class in particular. There are various different asset classes. There are equities, which is basically stocks, shares in a company, which is where the S&P 500 would fall into. There are alternatives. There's real estate, which often falls under alternatives. There are commodities. That's a completely different asset class as well, where you'll find agricultural goods. You might find coffee. You also will find gold and copper, all those lovely stuff in under commodities, so you can invest into that. I'll probably do a separate video on gold. I'm not going to go into that now. Commodities are often actually praised as being quite a good hedge against inflation because it's really based on supply and demand dynamics as opposed to profitability, which is the case for equities a lot of the time. You've also got bonds, also called fixed income. And essentially here you are lending money and you'll receive that money back with some interest on top. So you can think about government bonds, for example, that would fall under this category. Bonds often offer lower returns though, which is something to be aware of because they're typically lower risk. And a good example of this is government bonds. Lots of things outside of the S&P 500, but not only just that, also just outside of the equities asset class in general. I, for one, would always be putting most of my money in the equities asset class because that's where you're probably going to get higher returns. But it was a good thing for me to understand throughout this journey that there is more to investing than just the S&P 500. Each of these different asset classes and each of these investments all behave differently. And this is really where diversification comes in. I also realized even if I want to stick with this particular asset class of equities, I can actually buy stocks and shares somewhere else too. I can also invest in other ETFs and other different funds that are outside of the S&P 500. There are global funds like Vanguard's FTSE All-World ETF. And essentially what this does is track the top performing companies in the world. So it's across different continents. It's not just solely based in the US economy. I mean, let's keep one thing clear. It's still predominantly going to be US companies, but it does also have companies from all of the different continents across the world. And I think this is actually quite important because if you are invested only in the S&P 500, you are heavily exposed to the US market. So if anything happened, let's say in an alternate universe where the US economy completely crashed and collapsed, so would your investment portfolio. You are essentially betting on just one economy. However, with something like the FTSE All-World, you've got various different economies across the world. Most of the companies in the S&P 500 are at the peak of their life cycles. So these are large cap companies, which means that there are very small opportunities. There's little opportunity essentially to capture the growth that comes with investing in small cap companies. So startups, for example. These are all different things to think about if you're still interested in investing in stocks and shares that are outside of the S&P 500. The final lesson it taught me is very, very short and sweet. It taught me that time in the market definitely beats timing the market. It's not about over-fixating and over-complicating this whole thing, right? Thinking about, oh, I wish I would have invested in the past. I wish I could have invested in the 80s when I wasn't even born or conceived. It's not about thinking, should I time it until the market crashes? I mean, these things you can do, but I would typically say, and I think most people would say, it's really about how long you stay in the market as opposed to trying to time the market and trying to find the exact right point in when to invest. If the market has dipped and you can take advantage of that, then go ahead and do it. But if it's been on your mind for a long time to invest, you finally got the money ready, but you just don't feel like it's a good decision because maybe you can wait 5 months when you think the market might collapse, I would encourage you to just do it now, because if it is genuinely a long-term play and you're going to be in the market for a long time, there are going to be guaranteed dips and there are going to be high times as well. It's going to go up and down, and this will all balance out if you're investing for a period of like 20 years. As I said, when I first started investing at 23, I thought it'd be 10 years and by 33 I'd be done and take out my money. But now that it's been 4 years and I'm nearly hitting that halfway point, I'm thinking more of like 15, 20 years, and even probably, I'll just be honest, probably above 20 years as well. And that's where the real results come from, right? Consistency and time, and letting both just do their thing. But if I was to summarize my video that I've just done in a couple of words, firstly, know what you're investing in. Secondly, invest consistently. Thirdly, don't go into investments with emotion. Don't panic sell, and think long term. The S&P 500 isn't this magic ticket to wealth, but there are lots of reasons as to why it's so popular and why people suggest it. It's easy to do. Honestly, you set up an account, and if you've got spare money, you can put money into this particular investment. It's low cost. We'll discuss costs of different ETFs in another video, but it's a very low cost investment. And there's someone doing the work and managing it for you. It's literally tracking the 500 top performing US companies. And I say all that to say that this is my journey. This is what I've learned in the past 4 years. I hope some of the things that I've learned so far will be able to help you. If you've got any questions, challenge, disagreement in the comments, please let me know. I'm still learning. I want to keep re-emphasizing that. I'm still learning, and I'm a lover of learning. I'm a lover of knowledge. So if you've got anything that you want to share, let me know. Thank you so much for watching. If you want more content that is finance and is based about a girl who has no banking and finance background, has not worked in banking and finance, has not got a finance or accounting degree, but is just a regular girl like you and me that has actually managed to leverage the knowledge that's available online, then let me know. I'll make more videos like this. Thank you for watching. I hope you've enjoyed it. And yeah, I'll see you next time. And if you really like this video, I really think you're gonna love this video too.